Hello everyone. Today we will be presenting Chapter 14, Fraud Against Organizations, presented by Claudia Carvajal and Christopher Norton. Some statistics from the 2012 ACFA report are that annual revenue lost due to fraud is 5%. On average, fraud occurs for 18 months before being detected. 20% of cases had losses in excess of $1 million, and the average loss attributable to fraud is $140,000. The three main types of fraud against organizations are asset misappropriation, corruption, and fraudulent statements. The first main type of fraud that we will cover is asset misappropriation. Misappropriation can take three forms. The first of which is stealing cash or other assets that are coming into an organization, stealing cash or inventory that are on hand, or committing disbursement fraud by having the organization pay for something it shouldn't. It should be noted that these individuals, namely employees, vendors, and customers of an organization, can either act alone or collude with others to commit this type of fraud. Asset misappropriation can be broken down into two main categories of cash and inventory and other assets. The main types of cash misappropriations are larceny, skimming, and fraudulent disbursements, which we will discuss further in later slides. The first type of fraudulent disbursements that we will discuss is billing, which is a scheme in which a person causes his or her employer to issue a payment by submitting invoices for fictitious goods and services, inflated invoices, or personal purchases. Next is check tampering, which is a scheme in which a person steals his or her employer's funds by forging or altering a check on one of the organization's bank accounts, or steals a check the organization has legitimately issued to another payee. We then have expense reimbursements, which is a scheme in which an employee makes a claim for reimbursement of fictitious or inflated business expenses. Next is payroll, which is a scheme in which an employee causes his or her employer to issue payment by making false claims for compensation. We then have wire transfers, which is any scheme in which a person steals his or her employer's funds by fraudulently wire transferring them out of the employer's bank accounts. Finally, we have cash register disbursements, which is any scheme in which an employee makes false entries on a cash register to conceal the fraudulent removal of cash. The three main types of inventory and other fraud is the theft of inventory, the theft of information, and finally, the theft of securities. Next, we will discuss the key point for asset misappropriation and the takeaways. The following is some of the key points of asset misappropriations. Next, we will discuss corruption, which is the second type of fraud against organizations. The definition of corruption is when a person uses his or her influence in a business transaction to obtain an unauthorized benefit contrary to that person's duty to his or her employer. There are four basic types of corruption schemes, which we will cover in the next few slides. First is conflict of interest, which is a scheme in which an employee, a manager, or an executive has an undisclosed economic or personal interest in a transaction that adversely affects the company as a result. The next type of scheme is bribery, which is any scheme in which a person offers, gives, receives, or solicits something of value for the purpose of influencing an official act or a business decision without the knowledge or consent of the principal. Next, we have legal gratuities, which is any scheme in which a person offers, gives, receives, or solicits something of value for or because of an official act or business decision without the knowledge or consent of the principal. Finally, we have extortion, which is the coercion of another to enter into a transaction or deliver property based on the wrongful use of actual or threatened force, fear, or economic duress. The last common type of fraud against organizations is fraudulent statements. Fraudulent statements is the fabrication of an organization's financial statements to make the company appear more or less profitable.